Now, there's no doubt the price of property is sky high. It's been rocketing up despite higher interest rates. And while that's a big problem for first home buyers wanting to get a foot on the property ladder, it could offer a solution to another problem we're facing. Millions of Australians are set to retire over the next few years. And if the super balance or your retirement savings aren't enough to keep older Australians going, tapping into the value of the family home could well be the answer. And it is becoming more popular. Reverse mortgages were up by 40% over the past year, and with an eye-watering $1.3 trillion locked up in property, that equity could be the key to solving some problems for our nation's retirees. It's an idea that's been given the thumbs up from our nation's risk management professionals, with the Actuaries Institute releasing a report today calling for more people to make use of the value stored in the family home or to consider downsizing to a smaller property to help fund any shortfall in retirement savings. Andrew Boal is the chair of Actuaries Institute Retirement Strategy Group, and he joins me now. Andrew, welcome to Money News.
Thank you very much.
So we're not seeing the value that we hold in our family homes being realised at the moment?
No, there's a whole lot of money tied up in the home, as you suggested. In fact, for retirees alone, it's over $1.3 trillion. One of the things we've seen in other research is that last year, about 60% of retirees had less than $250,000 in super. Now, as the superannuation guarantee continues to mature over the next 20 years, that will change. But in the meantime, we're looking for ways to see how we can help retirees to generate some more income in retirement, to live a better life and enjoy their retirement like they should deserve to.
And I think a lot of people weigh up whether they should be scrimping and saving in their retirement against perhaps moving and gaining more security. It's a big decision to make.
It is. Now, one of the good things that we've got at the moment is there's a whole lot of schemes out there available. As you suggested, reverse mortgages is one, to give people access to some of the funds that's tied up in the home. The government has one as well. It's the Home Equity Access Scheme, and that's also had increased take-up rates in recent years as people become aware of it. And I think that's part of the problem, is that there's a lot of people aren't aware of a lot of these financial solutions that are available to them. Downsizing is one, but there are certainly some other opportunities to take advantage of some of these schemes.
I think a lot of people are reluctant, though, because the aim of the game is to pay down debt and to own your home outright, and we're told by so many financial planners to aim to achieve that, and that's an important goal to aim towards. So then the idea of taking out a reverse mortgage, potentially handing the debt on to your kids and grandkids, a lot of people are reluctant to even consider it.
Well, there are a lot of protections in place for a lot of these reverse mortgages and other schemes. So, for example, the Home Equity Access Scheme, you can get access to up to 150% of the age pension when you access it, and there are limits on how much equity it will eat into your home. So, a lot of these schemes will only allow you to get up to 20 to 25% of the equity tied up. So if the value of your home has gone up a lot, which it has in the last 20 years,
yes,
the property prices have really exploded. Some of that equity, if the home was worth $2 million, is now worth $3 million. If you use 20% of the equity to fund a better lifestyle for yourself, you're still leaving 80% to your children as a bequest, and that's still an enormous amount of money. So
should there be some changes to the pension assets test?
Well, there's a couple of test changes that we've called for in relation to the test. They go a bit each way. One, though, is that if people do access some of the money that's tied up in their home, that we would like to see that the first $300,000 of any money released continues to be exempt from the means test. So if somebody does downsize and releases $500,000, then if they're a single person, that $300,000 would be exempt from the means tests. Or if they're a couple, $600,000. So that would mean that there's removing some of the disincentives to downsize. There is a bit of a lot of people that, not a lot, but a number of people who are living in $3 million homes, living off the age pension, and what we call asset-rich, income poor. And so making them aware of these products and how to get access to some of that money, but also giving them some incentives to do it or removing the disincentive. And so we're also calling for part of the value of the home above a fairly high threshold to be included in the means test so that those people are also encouraged to access some of that equity so they live a better lifestyle themselves.
But you'll have a lot of people saying don't touch the value of the family home being exempt from the pension assets test because that's how they've set up their financial plan, and changing the goalposts on anything to do with the pension or super or retirement, it can lead to a lot of people seriously missing out because they've planned according to the rules we have in place.
Yeah, so the family home was exempt from the means test from 1985. So it's only been really in the last, 45 years that's been the case. That's still a long time.
Yeah, and people have planned their finances accordingly.
But any change like this would need to be introduced gradually. And so when the Henry Tax Review first looked at this in 2010, they proposed a threshold of $1.2 million. So an amount above that would be included in the assets test. If you index that just at 4% per annum since then, that would be now a bit over $2 million, about $2.1 million. And that would capture about 10,000 pensioners. So a relatively small number. So it's not like it's going to capture all the pensioners, but just those that have got very expensive homes now, and provide them with some incentive to access some of that capital and use it to improve their lifestyle in retirement. Because if you're accessing an age pension still at the moment, you certainly could be living a much better lifestyle if you use some of that equity.
And what about stamp duty? Because you're calling for that to be scrapped, which it is a big roadblock for people who want to consider downsizing, but you'd be dreaming for any government to turn off the rivers of gold that stamp duty provides. It's never going to happen, is it?
Well, in various jurisdictions around the world, it's not common. So other places have land tax, and we have that here too, up to a certain degree. The ACT government, about a decade ago, actually started the transition away from stamp duty.
But they're the only one in the whole country. The rest of the state government to be saying, we're not touching it.
Well, I think you can also now voluntarily choose between, if you're a new home buyer in New South Wales, to choose whether you want to pay stamp duty or whether you want to pay a land tax on it, and that decision will then depend on how long you expect to stay in the home. So we are gradually leaning into this as an issue, but certainly with stamp duty at the moment, if you're looking at it for the over 55s, if you wanted to downsize, paying a lump of sum like that to the government is a bit of an impediment for people to downsize. And if we could remove that impediment just to the over 55s, we might free up a lot more houses that are suitable for families to live in, rather than a single or a couple pensioners living in a 5-bedroom home still.
Yeah, look, it's absolutely worth looking at with the housing crisis we've got in the country as it is. Andrew, a lot of food for thought. Thank you so much for joining us.
My pleasure. Good to talk to you.
Andrew Boal there from the Actuaries Institute. And yeah, a lot of